In 2007, Warren Buffett made one of the strangest and boldest wagers in financial history. He wasn't betting on a single company or a hot new technology or some complicated Wall Street product, but instead, he bet on what seemed at the time like the dumbest investment strategy imaginable, buying all the stocks in the market according to their size and then doing absolutely nothing for 10 years. It wasn't a flashy prediction. It certainly didn't excite Wall Street's brightest minds. In fact, it almost sounded lazy. Why would the most respected investor alive put real money, $1 million, on a strategy that required no analysis, no market timing, and no sophisticated trading maneuvers? Buffett's challenge was direct. He invited any professional money manager, hedge fund operator, or financial wizard to go up against him. On his side, he had a simple S&P 500 index, basically a basket that included the 500 largest US companies. On their side, they could choose any hedge fund or actively managed strategy that they wanted, with all the research, trading, and high fees that came with it. The terms were simple. After 10 years, whoever investment grew more would win the bet. The prize money would go to a charity. When 2017 arrived, the results weren't even close. Buffett's boring index fund crushed the competition. It wasn't a narrow win, it was a landslide. The professionals with their armies of analysis, lightning-fast trading systems, and insider connections had been humiliated by the strategy that literally required you to do nothing except holding in the market. Buffett's bet hasn't just aged well, it continues to prove itself today. The idea that buying the market and sitting on it could outperform some of the smartest traders on earth seemed almost insulting to those that dedicated their lives to financial analysis. Yet the numbers keep piling up in favor of this index fund. This raises the key question: how could nothing beat the best and brightest minds in the finance world? How could a passive, automated approach win against people who dedicated decades of their lives to studying the markets, spotting opportunities, and trading at lightning speeds? Welcome back to Success with Steven. My name is Steven Smith, and on this channel, we discuss all things financial literacy. And today, I'm going to explain to you how to beat the stock market and the paradox of doing nothing. So without further ado, let's get right into the video. Now, at first glance, this does feel like a paradox because how can you beat the stock market without actually doing anything? But to truly understand why Buffett was right, we need to peel back the layers of modern markets. We need to step into a world that few outsiders ever see, a world of cryptic jargon, high-stakes bets, algorithms fighting for nanoseconds, and traders who either provide invincible value or drain the system depending on who you ask. This is a war over every penny. It's a battle between humans and machines where strategies are guarded like state secrets, and it's a world I once stumbled into myself. At the time, I believed, like many others, that high-frequency trades and market makers were creating a rigged game. And while there are some ways to manipulate it, it can't be rigged altogether. But one asset made me flip my perspective completely. That's when I realized why Buffett's bet was not only brilliant, but it's also inevitable. So let's go back to 2017 and look at the world of cryptocurrency. Bitcoin had crossed major milestones that year. First $1,000, then $2,000, and the excitement was unlike anything I'd ever seen. At the beginning of the year, Bitcoin started at $998.33, and at the end of the year, it went to $14,156.40. Money was flowing into the market at a pace that made the stock market booms look like they were tame. And I had been following Bitcoin since the movie Dope. Soon, the world is only gonna sell and buy products using Bitcoin. That is the first line of that film.
Soon the world is only gonna buy and sell products using Bitcoins.
So if you haven't seen it, I highly recommend that you check it out. Now, at the time, owning a few coins felt like a game that really wasn't a serious investment. But by 2017, something had changed. The price movements were no longer just numbers on a chart. They represented a flood of new money, people rushing into exchanges all over the world, desperate to get a piece of the action. At this time, the same coin could be traded at vastly different prices depending on where you looked. On one exchange, Bitcoin might be selling for $1,950. On another, it was closer to $2,100. In traditional finance, where massive institutions with supercomputers keep everything tightly synchronized, these gaps rarely last for more than a few seconds. But in crypto's early days, these price differences sometimes would persist for minutes or even hours. It seemed too good to be true. You can buy the cheap coin in one exchange, and then it could be sold higher at another one, and you could pocket the difference. Free money, right? At least that's how it looked. So of course I came up with a plan because that's what I normally do. And the strategy I envisioned was not limited to simply buying low and then selling high. I realized there was a way to create profitable loops. Imagine starting with the US dollar. You then buy Bitcoin and then convert that Bitcoin into Ethereum and finally sell the Ethereum back into dollars. If the exchange rates across those three trades didn't quite line up mathematically, you could end up with more dollars than when you started. Some of you may know this, but it's known as arbitrage. It's the art of exploiting indifferences between markets. And in those chaotic crypto days, indifferences were everything. Kind of like when I talk about retail arbitrage with Amazon, it's the same thing. You could buy something here and then you could sell it over on Amazon for more money. That is the arbitrage. However, the easy profits didn't last very long. Within weeks, professional firms had entered the space, armed with deeper pockets, faster systems, and more sophisticated algorithms. The opportunities disappeared almost overnight, leaving only razor-thin margins. At first, it was frustrating, but then I realized something profound. The very fact that these inefficiencies were disappearing was good for the market as a whole. And let me explain. The gaps between exchanges, once large enough to drive a truck through, were closing. Prices began sinking across platforms in real time. Suddenly, whether you were buying Bitcoin in Tokyo or in New York, you were paying roughly the same price. In other words, the traders who were stealing opportunities from me were actually providing a service. They were stitching together a fragmented system into something coherent, spreading information instantly across the globe. So when news broke that would affect Bitcoin's value, it was no longer confined to one exchange. Within minutes, it rippled everywhere. This wasn't just about crypto, it mirrored a lesson from traditional markets. Back in the 1980s, stock markets faced a similar challenge. Large institutions like pension funds needed to buy or sell enormous amounts of stocks, sometimes tens of millions of dollars worth, all at one time. But when they tried to do it, the market would seize up. A giant order might drive up the price of a stock by 8% or more simply because there wasn't enough depth on the other side to absorb it smoothly. The solution came in the form of market makers, specialized traders who constantly posted buy and sell orders near the current price. Their presence meant that even massive trades could be executed with only minimal price movement, a phenomenon known as reduced slippage. What I had stumbled into with Bitcoin was the same principle playing out in real time. Competition wasn't chaos, it was order, and it was crucial not just for big institutions, but for ordinary people. Without it, markets could be unstable, unfair, and prone to wild distortions. The more I studied, the more fascinating that it became. Arbitrage wasn't just about spotting a lucky mismatch, it could be described geometrically. Imagine plotting the price of Bitcoin across two exchanges on a graph. If the price matched perfectly, you'd be sitting on a neat diagonal line. No opportunity. But the moment one exchange drifted away, you'd be off the line. That gap represented profit waiting to be captured. Add more exchanges and currencies and the picture grows into higher dimensions, planes, tubes, and complex shapes. Arbitrage was like gravity, constantly pulling prices back towards equilibrium. Traders weren't just vultures circling around, they were bees, buzzing from flower to flower, pollinating the market, keeping it alive and keeping it balanced. Every time they captured a profit, they nudged the system closer to fairness. But here's where things get really interesting. Once the most obvious arbitrage opportunities vanished, traders didn't stop, they evolved. Instead of looking for price differences that existed in the present, they began focusing on the future. Could they predict where prices were headed, even by just a fraction of a second? Could they spot patterns in how one stock reacted to another, or how news from one corner of the globe rippled through the rest of the market? This is where short-term statistical trading collided with long-term investing, and it's here that we circle back to Warren Buffett. Let's talk about Coca-Cola and the difference between reacting to the market in the moment versus ignoring it altogether. When Warren Buffett made his $1 million bet on index funds, he wasn't just trying to prove a point about passive investing. He was also reinforcing a philosophy he built his entire career on. Ignore the noise of the market in the short term and focus relentlessly on long-term value. This philosophy came directly from his mentor, Benjamin Graham. In 1949, Graham published The Intelligent Investor, and this was actually one of my first investing books, but this was a book that became the Bible of value investing. Graham argued that the stock market is like a manic business partner called Mr. Market. Each day, Mr. Market shows up at your door offering to buy your shares or sell you more shares at a new price. Sometimes he's offering absurdly high prices, other time he's depressed and he's practically giving away stocks. The lesson was simple though, don't let Mr. Market's mood swings dictate your decisions. Instead, focus on the underlying business. If the company is fundamentally strong, earning profits, growing steadily, and positioned well for the future, then it doesn't matter if Mr. Market is panicking today, the business will eventually prove its worth. A perfect example of this philosophy in action was Buffett's legendary investment in Coca-Cola. By the late 1980s, many investors saw Coke as an old, mature American soda company. And sure, it was profitable, but its best days seemed like it was behind it. How much more soda could Americans drink? Buffett, however, saw something different. He wasn't looking at the American market. He was looking at the world. So at the time, the average American consumed about 300 Cokes a year, but in China, that number was 3. In India, it was less than 1. Those figures weren't just statistics. They were sparks waiting to ignite a fire. You see, Buffett recognized that Coca-Cola wasn't just selling sugar water, it was selling an image, a lifestyle, and a brand that resonated globally. He believed that as developing countries opened up and incomes rose, Coke would spread like wildfire. He also admired the company's leadership. The CEO at the time had this ambitious vision to make Coca-Cola available everywhere on Earth, to make it the world's drink. And that kind of mission aligned perfectly with Buffett's long-term mindset. So in 1994, Buffett made a bold move. He poured roughly 35% of his fund, about $1.3 billion, into Coca-Cola stock. Wall Street thought he had lost his mind. Why tie up so much capital into a boring beverage company? But Buffett's conviction was unshakable. By 1998, just a few years later, reality caught up to his prediction. Coke sales exploded across the globe, and his $1.3 billion stake had grown into $20 billion. It became one of the most profitable investments of his career. Buffett had ignored Mr. Market's daily mood swings, and he tuned out the noise and focused on long-term fundamentals, and he was rewarded massively for it. But here's where the story takes an interesting turn. Buffett's style of investing only works because of the very traders he often criticizes. The short-term traders, the ones that react to news, earning reports, and geopolitical events in real time, are the ones who keep the market efficient in the short run. Think of them as information injectors. Every time new data emerges, whether it's oil production numbers from OPEC or a surprise earnings report from a tech giant, these traders pounce instantly. They update prices second by second, ensuring that the market reflects the latest reality. Buffett doesn't care about those short-term moves, but he relies on the fact that markets as a whole remain efficient thanks to these traders. Without them, long-term predictions wouldn't work as cleanly. The prices Buffett buys at wouldn't reflect reality, and his calculated bets on the future growth would be distorted. So, in other words, Buffett's calm, long-term approach is only possible because of armies of short-term traders that are working furiously in the background to keep the markets fair. The two sides are not enemies, they're partners in this invisible dance. So, if Buffett represents patience and discipline, then Paul Tudor Jones represents the opposite: speed and instinct. He's one of the most famous short-term traders in history, known for reacting to new information with breathtaking speed. Jones once explained that anytime a group like OPEC announced plans, he couldn't resist betting against their ability to stick to them. He stated, "Wild horses couldn't keep me from it," because he knew from experience that getting 13 oil-producing nations to agree on production cuts was nearly impossible. He bet against their success, and more often than not, he was right. And this is what short-term trading looks like at its best. It's messy, emotional, and chaotic, but it is also very crucial. Traders like Jones are the ones injecting reality in the prices. When economic data comes out, when geopolitical events unfold, when unexpected shocks hit, they're the first to react. And their frantic decisions may look like noise, but collectively, they ensure that prices reflect the latest state of the world. And without them, Buffett's calm strategy of ignoring Mr. Market just would not work. So in my opinion, the irony is striking. Buffett preaches ignoring short-term volatility while short-term traders thrive on it. Yet the two approaches are symbiotic. Short-term traders keep prices aligned with reality in the moment, and long-term investors like Buffett profit when the broader trends of those prices eventually reveal themselves. It's like a relay race. Short-term traders sprint first a few meters, reacting to every bump in the road. Then long-term investors like Buffett take the baton and run the marathon, carrying those insights to the finish line. And this symbiosis sets the stage for the next evolution, when short-term trading became so complex, so interconnected that humans alone could no longer keep up. That's when machines entered the picture and finance entered a brand new era. By the time short-term traders had squeezed out most of the inefficiencies of the market, a new question emerged: where could profit still be found? If arbitrage opportunities were vanishing in seconds and competition was relentless, then what was left? The answer came in the form of statistical arbitrage, an approach pioneered in the 1980s that didn't look for obvious price gaps between exchanges, but instead for hidden relationships between assets. Take Coca-Cola and Pepsi. On the surface, they're direct competitors selling nearly identical products. Naturally, their stock prices tend to move together. If Coke rises sharply on good news, then Pepsi often follows. Not because Pepsi did anything differently, but because the two companies are linked in investors' minds. Statistical arbitrage, often shortened to stat arb, looks for these patterns. Traders create models showing the typical relationship between two or more stocks. If that relationship breaks down, say Coke plunges while Pepsi rallies, then they bet on it snapping back. In 1985, when Coca-Cola launched New Coke, consumers revolted and the stock price fell. Pepsi surged in celebration, launching ads mocking Coke, but statistical arbitrage traders saw something different. They bought the beaten down Coke stock and shorted Pepsi, profiting while the relationship normalized. It was a revelation. Markets weren't just individual prices bouncing around randomly, they were interconnected webs with invisible strings pulling companies together. And if you could map out those strings, you could profit when they stretched too far. No one took this idea further than Jim Simons, a former mathematician and code breaker who became the most successful trader in history. His hedge fund, Renaissance Technologies, built models that treated markets like geometric surfaces. Simons once studied how points on a surface distorted when stretched or bent. Later, he realized stock prices behaved in much the same way. They normally move within certain shapes or corridors. When they drifted off those shapes, his model predicted they would snap back. But unlike traditional investors, Simons didn't care why. He didn't need a story about Coke or Pepsi. He only cared that the math worked. His team, which famously avoided hiring people from finance, built machines and learning models that ingested everything: prices, economic data, even weather and satellite imagery. The model spit out thousands of tiny trades, each with a slight statistical edge. Alone, any one of them looked insignificant, but together they produced returns so extraordinary that the Medallion Fund became legendary, compounding wealth faster than anything the market had ever seen. And the secret wasn't clairvoyance, it was the relentless exploitation of patterns invisible to humans. Simons had turned markets into a math problem, and his computers were solving it in real time. When you step back, the whole system begins to resemble a hive. Millions of traders, algorithms, and investors buzz around constantly, each chasing their own goals. Some are reacting to news in seconds. Others, like Buffett, are making bets that will take decades to play out. Some are mapping correlations between thousands of stocks, while others are simply buying a broader index. Eventually, their actions may look random, even chaotic, but collectively, they create order. Prices gravitate towards fairness, not because of a single genius, but because of a swarm. Every trader, every algorithm, every decision is a bee, pollinating the market and keeping it alive and self-correcting. This hive is not perfect. It overreacts, it panics, and it occasionally crashes. But over time, the constant push and pull keeps it balanced. And this is exactly why Buffett's bet on doing nothing always works. In the 1960s, an economist named William Sharpe had a breakthrough. He realized that if you combine the holdings of every investor in the world, you get a single portfolio that perfectly represented the market as a whole. He called it the market portfolio, and by definition, this portfolio captures the collective wisdom of everyone: Buffett, Simons, Jones, the day traders in their bedroom, the pension funds in California, the hedge funds in New York. Everyone's bets, wins, and the losses are baked into this. Here's the twist. If you simply buy the market portfolio and you hold it, you automatically earn the average return of all investors combined. That may not sound exciting, but who wants to be average? There's a catch. Because you pay no trading costs, you actually beat the majority of active investors after fees. Every time a hedge fund makes a trade, they're incurring cost. Every time a short-term trader is wrong, it drags down their results. The market portfolio doesn't suffer from those problems. It simply rides the wave of collective wisdom, compounding relentlessly. This insight gave birth to the index fund. In 1976, John Bogle launched the first S&P 500 index fund, allowing ordinary people to buy 500 stocks in one simple product. It was mocked at first, because why would you settle for average when you could pay a professional to try to get you more? But over time, the numbers spoke louder than the critics. Bogle's index fund constantly outperformed the vast majority of actively managed funds, not because they were smarter, but because they avoided the pitfalls of trading, cost, and human error. Since 1976, Bogle's ordinary index fund has outperformed the market 90% of the time. This brings us full circle to Buffett's $1 million bet. By backing the index fund, he wasn't just saying traders were useless. Far from it. He understood that the hive of traders, both human and machine, constantly ingested information into prices. Their collective work is what makes the market portfolio so powerful. What Buffett was really saying is this: you don't need to outsmart the hive to benefit from it. You can simply own the hive itself. By holding the market, you harness the efforts of every trader on earth, from the fastest algorithm in Chicago to the long-term visionary in Omaha. And the results are staggering. Buffett once pointed out that if you had invested $10,000 into an S&P 500 index fund in 1942 and reinvested dividends, by today, you would have more than $50 million. You wouldn't have needed special skills, insider information, or even much patience. You just had to buy once and never sell. So again, how does doing nothing beat the best traders in the world? Because in markets, activity comes at a cost. Active traders may win big one year, but over decades in fees and mistakes and competition grinding them down, index funds, by contrast, never tire. They never panic, they never miss an opportunity because they already own everything. Buffett knew this. He bet on the simple truth that in the marathon of investing, the tortoise beats the hare, not by sprinting faster, but by steadily marching forward without tripping. And so the paradox resolves itself. The secret to winning in the most competitive game on earth is refusing to play the game at all. I want to thank you guys so much for watching this video. I do know that it was very long and this was a lot of information, but I really do feel like, knowing how my channel is, this video won't perform well, but I believe that this is one of the most important things that you can ever teach someone, and knowing the history of how these markets work is so important if you want to learn how to take advantage of them and you want to learn how to profit from them. So if you guys want more information like this, if you want more breakdowns like this, please subscribe to the channel and drop something below. In fact, drop the word wealth. If you feel like you got value from this information, drop the word wealth in the comments below. That way I know that you enjoy this content, and then that'll let me know I can make more of this, because I really love to learn about how things work, because the past will dictate what's going to happen in the future. And this is great information for someone who has not invested whatsoever, or someone who's been investing for years. Either way, it can help you. So once again, thank you so much for watching this video, and you guys have a wonderful day.